Hello everyone, I am Jeel Shah from WealthTrust Capital Services. We are glad to have you with us today. Today we'll walk you through our multidimensional investment strategy where we focus on picking companies that show strong earnings growth, maintain low debt, and have a clear path for long-term growth. So with this, let's get started. Over to you, Sneha ma'am.
Hello, everyone. Thank you for joining us. And we'll straight away dive into what our strategy for multidimensional looks like, whether it's a portfolio meant for you, what to expect from it, and how do we really get into picking stocks and what our exit strategy also looks like. So our research philosophy largely sets on four pillars. Okay, so we look at businesses. So first, the ideology that we follow is a top-down approach. Only if, from a macro point of view, businesses or sectors do add up, we then pick up those sectors. Okay, so we do look at macros and we do look at a top-down approach to come to come, to finalize the stocks within those sectors that we really like or we feel has great growth potential. So our research philosophy, once the sectors and the stocks have been finalized, depends on four main factors that we look at. First is sustainability, where we are looking at we're looking at businesses which we believe that will be sustainable in the next 5, 7, 10 years. There are many businesses which can be they may not be very long term in nature, or they may not have as much demand, or the demand of such products and services is going down. So it could be there that these businesses are not in that growth phase, right? So we look out for businesses where there is exponential growth that is expected. Of course, profitability is a very big, part that we look at within those businesses, whether they are growing every quarter, whether, the numbers are as per our expectations of the overall market. The finances need to be very, very crystal clear. We need to understand the numbers well before getting into these businesses, and leadership is a very key criteria. An example here would be, of course, for looking for companies which are growth oriented and are not. For example, if they have a lot of cash, there could be a lot of money, a bit of the money allocated to R&D, to further innovate, to further grow, and not businesses which probably will probably give this as back as dividends or buybacks. We are looking at businesses which has a lot of potential of growth, and that's how these businesses, especially in this portfolio, in the multidimensional portfolio, are carved out. Because these businesses are potential drivers of the future, we do have some holding period of these businesses, and because they are growth drivers, we do expect, and since they have been put in this portfolio with the sole reason that maybe one quarter may not be so good, but we're expecting this as a business or the sector to really revive and do well. We There may be a lot of volatility in couple of quarters in the business, and anybody investing in this portfolio has to be mindful that these are a little bit longer term hold calls, and we will not be just rebalancing them, even at excessive volatility. We'll rather add into these businesses if we feel that these businesses are something we stay positive on. So once we've checked these four pillars, we do tend to stay invested in the businesses even though there may be higher volatility in these businesses. So, how do we approach the idea generation, right? As I said, we as a firm look at top down. First, we do look at macros, and we look at how various macros. Let's say, there's some government, focus on a particular sector, or for example, sectors which are, which are consumer driven, like a Swiggy and Zomato, right? These are businesses which have a lot of demand because of the consumer, because of the actions of the consumer. So all growth businesses will have such actions. One is Swiggy, Zomato, which is because of the consumer. Could be hospitals where there's exponential growth expected, and within that, when we look at the government policies, etc., where they are pro-government policies. So we do look at the macro piece and then get into sectoral trends, whether we feel that the consumers are also liking this kind of a product, or there is acceptability in the market for such kind of businesses. Once we start liking those sectors, then we get into the business and the we get into finding the businesses within those sectors. And once we find that businesses, then we get into a bottom up kind of bottom up research. But there, in these companies that we select within the multidimensional portfolio, in our bottom up research, there may be some companies which are a little more overvalued. Like if you take, for example, Zomato, it may be a very overvalued company, though it may not come in our portfolio design, but any growth company may be a little highly valued because of the expectation of the growth within that company. That's the reason there also could be more volatility, but where we believe that the PE and the earnings both can expect exponentially grow over the next 2 3 years, or in the long term, that's when we really deep dive within that company, and then we do our bottom up research, and basis that and basis the market trends that we see for the next 5 7 years, we then that company gets allocated to our overall portfolio. Now, in terms of portfolio construction, we this portfolio has only about 12 companies at the moment, and we'll never go beyond 15 companies in this portfolio. So it is a very, very concentrated, high conviction kind of a portfolio. That's why even if one stock, right, does correct, given the volatility of the markets, the recovery also will take a quarter or two. But when we are very confident, rather than reducing the weightage, we'll actually add weightage to such a company, and that's how we'll manage the portfolio. And that's why you will brace yourself for some volatility within this portfolio, because this is meant for stocks where we believe the growth to be exponential. So we may have to wait for those ideas to actually pan out. And thus, it's very important for clients coming within this portfolio to understand that this will have its own set of volatility, which you need to be ready to accept. And we will stick to these companies because we are very high conviction on, and where we feel that there is a change in the market sentiments or the market trends, we will definitely replace that or take an exit call depending on the parameters within our bottom up research. So moving on, we actually concentrate within this portfolio in companies which are largely mid and small caps. Thus, you can expect high volatility, but these are companies where we expect exponential growth. We cover companies where there is not as much research available as much as the larger companies or efficiency of data available in. We also look at companies which within this mid and small cap segments are often overlooked, and not many analysts are also covering those companies. Thus, finding companies which may have a lot of potential but have not yet been covered by as many broking entities or analysts. Also, there may be unseen opportunities, and usually larger institutions focus on the large caps or companies which which gets spoken about a lot more. We are being a boutique firm, being a research only firm. We try to look for opportunities which are not as covered. And thus, though it's only a 12 stock portfolio, these will be largely companies you may not have heard of so much. But we have our own research reports written on them, on each and every company that goes within our portfolio. And you can have access to that as well, as to what is, a very detailed research report on why we are entering the company and what is our conviction on these companies. And that, as I said, that, we only take the exit calls when these companies as per our bottom up research parameters, they actually fall away from those parameters within our holding period. That's the time we actually take an exit call on these companies. Otherwise, they are companies we would like to hold for a much longer time. Also, we actively manage these portfolios, so we do change weightages depending on within those companies. Some may have hit our target prices, so then we will definitely manage it actively, and we may reduce our weightage, or we may completely exit a company once our target prices have been hit. And for companies where we find even after the target price hit, we believe that these companies have more potential. And, during our research, we have further kept that company as hold or further buy. Then we will keep adding to that position, and we'll exit out of that strategy. And we do have a lot of, we also have our own internal parameters, which are proprietary in nature, where we manage risk, particularly for companies where we find corporate governance issues or any issues we may get out of that company even before our target prices are hit, just because we come to know of something which we are not comfortable on holding that company within our portfolio. So we do manage these portfolios very actively because they're just 12 companies, and they are high conviction bets that we have kind of crafted the portfolio on, and thus we are very well aware of the risk and the reward that it can provide. So now I will hand over to Shubham, our senior research analyst, to take us through the portfolio in detail and how it's constructed and what to expect from it. Thank you.
Yeah, thank you, Sneha, for the amazing explanation. So, firstly, I would like to tell to our investors that this portfolio is not meant to be a market mover. Instead, it focuses on high growth companies across sectors that can deliver superior returns over the time. So that's the reason we have created this portfolio, that 60% of our portfolio is allocated to a business where we have 2 to 3 year time horizon. So these companies are well proven fundamental companies which has clear visibilities and the ability to compound steadily. And the rest 40% is invested in growth and momentum companies, where the businesses that allow to have a short-term trends, and we capitalize those opportunities to create a liquidity and an extra alpha overall the portfolios. So this dual approach allow us to balance stability with dynamism, and this creates an extra alpha to our overall portfolio. Our stock selection framework is very simple. We look into four things. The first one is earning growth. The business must demonstrate a clear path to to have a consistent earning expansion. The second most important thing is low leverage. We avoid companies which has high debt, because in down cycles, the companies which has very high debt can be a can be a problem to our portfolios, and it can destroy shareholder wealth. The third most important thing is experienced leadership. So a management quality is never in non-negotiable mode. We always look into the companies which have a very huge experience background, and after that, after checking it, then only we allocate our capital. And the fourth most important thing is capex. Expansion plans are very meaningful for the portfolios and any company whenever we pick it, right? Because as Sneha said that we invest on those companies which has very high growth capabilities. Capex is the most important thing. So, but we look into their operating cash flows. We just don't invest to any companies who are doing who are heavily into capex. So this discipline approach, ensures that our portfolio is not built on hype or narratives, but on business with resilience, capability, and execution strength. So why multidimensional? As Sneha has said that we also look into the macro and sectoral trends because understanding where the capital is flowing is the most important thing into industries. In multidimensional portfolio, we are into different sectors. It's not just about one specific theme or one specific sector where we look into, and then we jump into macro, and then we jump into bottom up. We are into different sectors, and this is the reason why we whenever there is a market correction, or we expect that if whenever the market will have a huge correction, because of investing in multi sectors, this could help us in the longer period of time. We also track liquidity flows, valuation trends, and momentum factors that can accelerate our stock returns. So by blending these dimensions, we avoid the pitfall of being one-dimensional investors. Instead, we positions our portfolio to benefit from different structural growth themes. To illustrate this in an example, I'll like to discuss about Titagarh rail system. So we identified this railway upcycle early, driven by the government capital expenditure and freight reforms. Titagarh, when it's Titagarh won around 27,890 crores of order book, which includes marquee projects like Vande Bharat, was a well positioned to benefit. So we realized that this could be a huge positive thing for this company. Then slowly and steadily, the company also expanded the capacity to 800 to 1,000 crores. And then in the coming years, they also backward integrated into traction motors. And we realized that this could help them to improve their margins. So as a result, it delivered a 95% earning growth coupled with a strong value re-rating. So this is an example, as we discussed in the past, that multidimensional approach. First, we look into the spotting the macro trend, where we saw that railway theme could be a huge upside. We got an idea that government is spending a lot. Government's expenditure is increasing, and then we started validating the business fundamental, and at the end we started capturing both earning growth as well as the PE expansions. So that's how we generate an extra alpha. That's the reason our return generation framework is similar to this. Okay, so let me share a live example about our portfolio, which we have picked in the past years. Titagarh rail system. So we identified the railway upcycle early, driven by the government capital expenditure and freight reforms. So past 2 year, 1.5 year back, right, government started their capital expenditure very heavily, and that's the reason there were a lot of government companies started running back. So we realized that Titagarh has a order book of 27,890 crores, which include marquee projects like Vande Bharat, and many new projects were upcoming. So we started analyzing it. We got an idea that government will start their government expenditure at a very rapid pace, and then we jumped into Titagarh as a company, as a fundamental company, where we were very confident that this could be a this could help overall project. The company then expanded their capacity to 800 to 1,000 crore. Backward integration was also on the cycle. They also started their backward integration into traction motors, and this eventually helped them to improve their margins. As a result, if you see Titagarh gain around 95% of earning growth in last 1.5 year. So this coupled both valuation as well as the re-rating. So this is a classic example of our multidimensional approach, because here everything was there, as we discussed, like in the past, that we jump into macro trends, we look into the government expenditure, then we jumped into a company where we bought where we saw Titagarh as a fundamental company, and then there was an earning growth as well as the PE expansion. So combining all these three framework, whenever we pick a company, these are the basic frameworks for us. As I said earlier, right, that our written framework is very simple. earning growth, that is EPS expansion. This is the foundation, and the second is value re-rating, that is PE expansion. That is a multiplier. So whenever we pick a company in a multidimensional portfolio, the first and most important thing is earning growth, and after, because of this, there is a value re-rating. When both aligns, right, stock prices benefit not only from the fundamental but also from the changing market perceptions. So this dual approach has been the driver of our best performance. So any company, whichever we pick, isn't a market mover. It's not like this. The companies will move as per the market conditions, but those companies need a value re-rating as well as earning growth expansion. Whenever these two things will occur, the companies in our portfolio will start going up.
So thank you, Shubham, for the, to take a deep dive into our multidimensional strategy. As mentioned, this is not a market mover, and it's not going to be parallel to what the market moves. These are 12 to 15 high conviction bets into stocks after we've done our top-down approach, and then getting into bottom up by seeing the earnings growth, whether they are low debt companies, their management is experienced, and they have capex plans which will give them exponential growth. So, if you want to be part of a portfolio whose journey is for the next 2 3 years, and the stocks will play out at least 60% of the portfolio in a little longish period, this is the fund or the strategy for you. Thank you.
Okay, so that brings us to an end of our presentation. As you have seen, our multidimensional strategy is built on a very simple idea. We truly believe that this approach helps us manage risks better while creating consistent wealth over the time. Thank you for your time. We would be happy to take any questions you may have. Thank you.